In the fintech space, the recent bankruptcy of a company called Synapse has left a lot of people stranded and money stranded as well. What are some lessons that you can take away, that we can all take away from this rough experience? I got that and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Personally, I wasn't aware of this incident and actually wasn't aware until a colleague sent me this article, and I'm assuming he wasn't aware until he saw it. Thankfully, this isn't a kind of pervasive and widespread issue, but my goodness, has it impacted some folks and in a very kind of awful and meaningful way. And earlier this year, a fintech company, financial technology company, Synapse, filed bankruptcy, and it essentially left a lot of people really stranded, either wondering how they could get access to their money. And guys, the fear is that the money is gone. So the company Synapse apparently was a middleman between the tech industry, so tech startups, and actual banks, real banks, small banks, where they basically were the intermediary setting up and offering checking accounts and debit cards and those sorts of things. So my understanding, again, not personally familiar with it, but they would help, not provide financing to the tech startups, but actually provide banking services to the tech startup employees. And what ended up happening is customers or these employees would then use the Synapse technology platform to then save money into and then draw out of. So treat it like a checking account or in some cases a savings account. In this example or in the article, some folks used it as resources when they sold a house. They were leaving the proceeds in this Synapse account. Other people were using this as a savings account to build up money for a down payment on a house or for their financial future. But Synapse wasn't a bank themselves. And they didn't claim to be, but it can be confusing, especially in the innovative space where you've got things like Venmo and Apple Pay and these things. Well, when you have money in between banks, well, where is that? And is it trustworthy? Is it reliable? Well, to a lot of people's surprise and sort of out of the blue, earlier this year, Synapse filed for bankruptcy. And these customers then, these employees were then saying, well, all right, my money's at this bank, right? So no problem. Well, when they would log in, their account was frozen, and in kind of most cases, very frighteningly, the money was gone. And it's very possible, there's more to the story, very possible there's even some foul play, but now these customers are left fighting and wondering, well, where are these dollars? And many people have lost thousands of dollars, tens of thousands of dollars, even in a couple extreme examples, a couple $100,000, seemingly secure, but now gone. So hopefully this is a unique example, an extreme example, and there isn't more of this that starts happening. But just looking as an outsider, hopefully you're an outsider, looking as an outsider, are there lessons that can be learned from this example, from this awful experience that you can apply in your own financial life? I think so. In fact, I would say maybe not lessons, but reminders. For us, as we're helping our clients with the 3-bank account system, this financial operating system for managing their cash and their cash flow, I've shared it many times before. It really is 3 different bank accounts. You've got your checking account where you're managing the money coming in and all of your monthly expenses coming out. Hopefully you're running that off of a budget, and then that's sort of your immediate spending, bucket number 1. Bucket number 3 we're all familiar with as well, and that's your emergency fund, and those are dollars that you're setting aside, hopefully up to 3 to 6 months of your monthly expenses. And then that money is safe and it's there for an emergency, true emergencies. You don't touch it otherwise. And then that bucket number 2, the one in between, is for all the stuff in between. And that is not the regular monthly bills, but not an emergency. So all of the things that you can plan ahead for, but that are non-monthly, they're irregular. Things like a car repair, things like a car replacement, things like new furniture, or even a down payment on a house. Christmas expenses or vacations, those sorts of things that are going to come up, but it's not a monthly budget item, and it's not an emergency. That's your delayed spending. So when we teach and apply those 3 bank accounts in the three bank account system, the first one's obvious, that's a checking account. But the others are typically savings accounts. And we coach that your savings account, there's 3 rules, there's 3 criteria, there's 3 must-haves when you're using a bank account, when you're using a savings account. And the first one is the money needs to be liquid. It's got to be accessible to you. And I think in this Synapse example, the feeling was that it was accessible. We could draw on it at any time, but yes, you need to have a savings account for either delayed spending items or emergency expenses that pop up. That's liquid. You can go get to it when you need it. So that's the first criteria. Second, this money needs to be free. The bank account needs to be free. And I know in some instances, HSAs are more the prominent example right now. A lot of banks charge servicing fees and so on. They used to have that on savings accounts and certain bank accounts. That's not really a thing anymore. Unfortunately, a lot of those expenses are hidden, but that's another one. You want to make sure that you're not paying the bank to hold on to your money, that the account is free. And I think in this example, Synapse, as the intermediary, they weren't the bank. They worked with other small banks and offered these services as kind of the intermediary, but I think it was free, okay? But that third criteria, that third rule for your savings account is it needs to be FDIC insured. It needs to be FDIC insured. So you've got that assurance that even if the bank has experiences of failure, like we saw a couple of years ago with some of the largest banking failures in U.S. history, that the money is still secure, right? And it's still guaranteed. And I think in this case, as I dug a little bit more into what exactly happened, I think there was some legitimate confusion here because Synapse was not the bank. They were just the intermediary, and they said that your money is actually going to be at a bank and it would be FDIC insured. But I think this is where some of the foul play is going to be found out. I don't think the money was actually there at the bank. I'm not sure where it was, and therefore it wasn't FDIC insured. But I think this is an example. Obviously, like the banking failures that we had a couple of years ago were another reminder of just, you don't think about, consciously, you don't have to worry about the banking system. And the reason for that is, well, it's FDIC insured. And so ensuring that the dollars, where they're at, whether it's checking or savings, an emergency fund, that they're FDIC insured, that you don't need to worry about, well, what happens if there's some issue with the bank, my money is safe. And then once you reach those 3 criteria, then go out and get the best yield possible, get the highest interest rate possible while achieving those 3 objectives. And that would be the other thing, that some of these examples of folks saving tens of thousands of dollars or even a couple $100,000, I would want to make sure that you're earning interest on that money. If that money is going to sit there even for a short time period via a couple months, you should be earning a strong interest rate on that. And for us, those are high yield savings accounts or money market accounts that are, yes, they are liquid, they are free, and they're FDIC insured, and then they offer a strong interest rate. So as awful as this experience is, and we haven't seen the end of it, there's going to be actions taken, and hopefully these customers are made whole. But for the rest of us, the lessons that we can take away, make sure that your banks that you're using, checking account, but certainly your savings account, they're liquid, free, and FDIC insured, and then go out and get the best interest rate possible. Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.